Good morning and welcome to the Killik and Co Market Update. This week, the Bank of England published its latest monetary policy report, and it was good to see that the bank struck a fairly optimistic tone. The bank has upgraded its forecast for the UK economy, and it now expects our economy to grow by 7.25% for the full year 2021. There were 4 quite helpful summary points at the start of the report, so we've put them on this slide here. So as you can see, the bank said that COVID weighed on economic activity at the start of this year. No surprises there. But it did also say that vaccines are helping the economy to recover rapidly, so that's certainly a positive insight. The bank has conceded that inflation is currently below its 2% target level, but it does expect it to recover once the economy starts to reopen. And finally, the bank also announced yesterday that it has decided to leave interest rates at their current record low levels of just 0.1%. There were a couple of other quite helpful charts in the report, so we've got a couple more here for you. The first one shows inflation in the economy since 2005. So as you can see, it has actually been quite volatile. We had quite a big dip in inflation back in 2015, and that was when oil prices fell to quite low levels. You can see at the moment that inflation is well below the Bank of England's target rate of 2%, but if you have a look at those pink dots, those are the future inflation forecasts of the Bank of England, and you can see that the bank is expecting inflation to recover quite quickly once we're allowed to start spending again. And this next chart here shows interest rates in the UK going all the way back to the year 2000. So as you can see, there were 5% in those pre-financial crisis days, but at the moment they're at record lows of 0.1%, and that will support businesses and consumers as the economy continues to recover, and it will discourage people from saving and encourage them to spend, and that will help our economic recovery. This week, a report was published by the International Energy Agency, or the IEA. The IEA is an intergovernmental organisation that was set up in the wake of the 1973 oil crisis, and it now works as an energy policy advisor to its various member countries. In the report, the IEA made the point that countries around the world are currently in the process of publishing their plans to reduce their carbon emissions, and a lot of these plans involve quite drastic action, for example converting from petrol or diesel vehicles to electric vehicles. And the agency makes the point that these changes will require a change in the types of materials that we need. And it does make the point that there could be some supply shortages in certain materials, and it even goes so far as to suggest that some governments might wish to start stockpiling some of the rarer of these particular materials. So here's the quote that has been making headlines this week. It comes from the head of the IEA, and he said that meeting our climate change goals will turbocharge demand for mineral resources, and that voluntary strategic stockpiling can in some cases help countries to weather short-term supply disruptions. So let's take a look at the types of materials that could be in question here. On this chart, we've got a list of the materials that are needed for a conventional vehicle in comparison to the materials needed for an electric vehicle. And the chart shows these in kilograms per vehicle. So on the top there, you can see that for a conventional vehicle, it's really just copper and manganese that are required. But for an electric car, you need copper, lithium, nickel, manganese, cobalt, graphite, zinc, and rare earths. So there could potentially be a huge increase in the list of materials that are required, and if all countries start trying to buy these at the same time, there could be some supply problems and also a potential increase in the price. So if countries do start trying to stockpile, we could see price rises, and that could potentially be good news for the mining companies that are producing these materials. And finally this week, the US has published its latest numbers on its trade figures, and it does show quite a big increase in its trade deficit for the month of March. So for the month of March, the US imported $275 billion worth of goods and services, while only exporting $200 billion worth. That means it has a trade deficit of $75 billion, and that's a notable increase on last year. So the implication here is that perhaps a lot of those stimulus checks that were sent to American citizens have not been spent in the US. They've actually been spent on importing goods and services from other countries, and that probably was not the intention when the government planned to send out these checks. Moving on to have a look at next week, we're coming to the end of reporting season now, so it's looking a bit quieter on the calendar, but we have got results out from Disney, Airbnb and Alibaba. That's it from us. Enjoy the weekend, and we'll see you next Friday.